This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, it is 3 p.m. on Tuesday, January 13th, 2015. I'm Lee Adler and this is Radio Free Wall Street. Well, I guess the story today, as it has been for many days over the last month or so, is the price of oil. So today I'm going to take a look at a couple of long-term charts of the oil price to see if we can get a handle on where this thing may be headed. Let's take a look at a couple of the charts on the oil complex, particularly West Texas Intermediate crude, and see if we can get a handle on where the bottom might be on that. Let's talk really long term. This chart goes all the way back to 1979 on a monthly basis. This is the price of the West Texas Intermediate crude futures contract, and it's on a logarithmic scale so that there's no distortion from this move. You can see the relative percentage changes all the way back 1979, 1985, when it was down near $10 a barrel, all the way up to the peak of $140 a barrel in 2008. So you see the percentage changes on an equal basis. There are three moving averages on this chart. I use smooth moving averages called triangular moving averages. They are the red line, which is the 48-month moving average, the green, which is a 144-month or 12-year moving average, and then this very smooth blue line, which is a 240-month or 20-year moving average. Below the chart, you see the commitment of traders data, the large specs, small specs, which we'll ignore, and the commercials. And then at the bottom of the chart, there's a percentage price oscillator that's based on a 4-year time frame. And you can see that the peak in the percentage price oscillator was all the way back here in 1980 when the market topped out at that time. Back here in 1979, the end of the year, I was a 29-year-old trader working for a Philadelphia options exchange floor trading specialist firm, but I was one of the upstairs traders and didn't know what the heck I was doing at that time. But I remember in November of 1979, there was a headline on the Herd in the Street column in the Wall Street Journal that said, "Analysts see no negatives in the outlook for oil." And I thought to myself at that time, that sounds interesting. It might be a good time to buy some puts or sell some naked calls, which I did on several oil stocks and several gold stocks at that time. So we have here the historical perspective. And the important thing about the top in 1980 is that it came in at about $40. And the market again topped out in 1990, also at about $40. And it built this massive base formation over a period of 23, 24 years. It finally breaking out above 40. And it kept going and going. And it formed this channel connecting these peaks here with these two peaks here. And then a parallel line from the lows intersected the 2008 low. In 2008, the market was also blowing off at the beginning of the year as everything else was falling apart, blew through the top of the channel, and that was the final top, and we had this enormous crash in the second half of 2008. And I would point out that the current crash is not on the same order of magnitude, but also we didn't get the same degree of extension. Now, the distance from the top of the channel to the bottom of the channel is 65 points. So say that's about a 65% drop. So a 65% drop from the 100 area or 110 would take us down in this level in here around $35 a barrel, which is where we also had a couple of congestion areas or tops and bottoms in 2001. We had a top here, a little slightly higher top in 2004, and then we had a bottom down here in this range in 2009. The $35 area is interesting in terms of potential major support. So is $40 here, where we topped out in 1980 and again in 1990. So the $40 area is a potential at the $35 area. I drew a parallel curve to this 20-year moving average. The reason being that the market topped out about 20% above this moving average in 1996, and it also bottomed at about 20% below this moving average in 2002 at the beginning of the year. So there's at least some indication that the market won't stretch much beyond 20% below this moving average, at least on the first try. So this would suggest that we're getting pretty close to some kind of an interim low here at around 45 bucks. Now, however, if we do go through that in the next couple of weeks, then again, we're looking in the $35 range or even down here at around $30. Now, I also want to point out that in terms of the commitment of traders, the large specs hit a record long position in the middle of 2014 at about 500,000 contracts long. They're still very heavily long at 272,000 contracts, so there's still a lot of room for adjustment there. By the same token, the commercials hit a record short position, 500,000 contracts in mid-2014, and they were correctly short at that point. And they're still significantly short. Finally, just looking at this percentage price oscillator on a 4-year basis, 4-year moving averages, it peaked at the end of 2008, gave a sell signal in here. It kind of was neutral, but showing some signs of distribution throughout this period of 2012 through 2014. Then it broke down in the middle of 2014, right at that point there. And it's still getting worse. It's just about to go negative. So here we've had this 15-year bull market. It first went positive in the year 2000, and it stayed in positive territory above zero. And it's just now coming down to that point where it's about to go negative. So that's another suggestion that this decline is maybe near an interim bottom, but still has perhaps a long way to go to work off all of the excesses that developed in the gigantic bubble in 2008. Let's zoom in to the last few years, back to January 2012 to be specific. Look at the weekly chart of the West Texas Intermediate, again with a couple moving averages at the top. Red 13-week, blue is 26-week, and then the green is 104-week or a 2-year moving average. And you can see that has barely begun to move. But meanwhile, the 13-week moving average is dropping very sharply. Look what's happened to the open interest on the futures contract. Peaked in the summer, well after the highs in 2012. There was still increasing demand for the futures. And the swap dealers were happy to write those contracts. And the producers were actually a little bit long at that point. But then they wised up. This red line here shows what the producers are doing. They actually got a little bit short by June of last year, which was a good time to be a little bit short, although they should have been a lot short at that point. But I mean, they may be the smart money, but they're not omniscient. As you can see, the swap dealers were the most heavily short. And up here at the top, the managed money, the stupid money for the entire middle of the year. In 2014, as oil was trading between $90 and $100 a barrel, these guys had record long positions. Managed money still is about 188,000 contracts long at this point. But up here in mid-year last year, they were close to 400,000 contracts long. They were about 350,000 contracts long. Now let's figure out how much money has been lost, because as I've discussed with you, this is real money destruction. When these futures contracts start heading down and those margin calls go out, those loans get paid off, money disappears. So you'll have 1,000 barrels per contract. And at this point here, we had let's say 1.75 million contracts times 1,000 barrels. That's 1.75 billion barrels of oil here were outstanding on the futures markets. in the West, just as West Texas Intermediate. This doesn't include Brent crude. We won't even go there as far as the additional losses. But the WTI, we were talking about 1.75 billion barrels of oil at $100 a barrel. So that's $175 billion at that point. That's been cut in half. Okay, that's been more than cut in half, but cut by 60%. Say roughly 120 billion. We've seen $120 billion in real money destruction that has taken place since the middle of last year. These are not moms and pops that are trading the futures contracts. These are major hedgers, major speculators that are trading these contracts, and they've suffered some massive losses. So there's real money destruction. Now, to keep this in perspective, the Fed's balance sheet is $4 trillion. And the ECB's balance sheet is $2 trillion, and the Bank of Japan's balance sheet is around $3 trillion US dollars equivalent. So there's a lot of cash out there, but still, we're talking some real money destruction here, and that's got to hurt. Now, I can do a manual visual centered moving average projection, and using the 13-week and the 26-week moving averages, I time shifted them manually back to the center of the time span where they would be centered with the data. And as you can see, centering both of those lines back 3 months on the 6-month moving average, the 26-week moving average, and back from here on the 13-week moving average. And what we see is the crossover point here is right around $68. And the peak of the cycle was somewhere in here. So these two peaks here at around $100 are going to be the top of the measuring point. So from 100 to 68, so let's say $32 from 68, that gets us down to $36. So again, that puts us in the range that we were looking at a minute ago on the very long-term chart, somewhere in the mid-30s. That's not a carved in stone number, but it's an area where I'd be especially looking for a bottom. Could be a few dollars higher than that, could be a few dollars lower. But until we see some signs on these indicators that this thing is beginning to at least form a base, I think we're going lower. Again, the percentage price oscillator here on a 13-week basis looks very weak. It's so oversold, we don't know where oversold is. You're going to see at least a minor positive divergence develop before you get the final low in prices. So normally after you get this kind of destruction, you're going to have probably some kind of a W pattern. It's not going to go down and turn on a dime. Unlikely anyway. It may have an initial spike, but then it'll come back and retest. And at that point, this indicator will start turning upwards, and we'll have a better handle on at least the bottom of this phase of this bear market in oil. Now, it's been underway for going on 4 years now. And just looking back at the last couple of major bear markets in the oil market, you may not remember this, but the 1980 market didn't bottom until 1986, 1987. So that was a 6 or 7 year bear market. And then from the top in 1991, the next bottom wasn't until 1999. So that one lasted 8 years. This one, we topped out in 2008, the first top. Then we had an enormous rally. So it's hard to say whether we should measure from that 2008 top or perhaps from the 2011 top. But from 2008, we're now 7 years into this thing. So it's possible we could get a major bottom over the next year. But considering the size of the recovery in 2009 through 2011, that was a cyclical bull market. So maybe this thing could go a little longer. But I think some point within a year to 2 years, we're going to see another major buying opportunity in the oil market. And we're going to have our antenna up as we get down into the low 40s. And particularly if we get into the mid to high 30s, we're going to be starting to look for signs of a bottom in those areas. I was thinking about what I've called the last Ponzi game standing. The U.S. markets have gone back and forth between whether it's the Treasury market or the U.S. stock market. But to some extent, just the U.S. markets in general have been the last Ponzi game standing ever since I first thought of the concept. Soon after the market first turned in 2009, I guess I first started to worry about the idea that all flows would lead to the U.S. sometime in the spring or summer of 2009. And I've kept that idea in my mind ever since, and it has played out exactly that way. The way I look at markets is that if they have made lower highs and lower lows over the intermediate term, say 5 to 6 months at least, then that to me is a bear market. And by that standard, we're seeing bear markets from the emerging markets. And of course, throughout the entire commodity complex, gold started it a couple years ago. Oil topped out when? In 2008, had another cyclical bull market through 2011, but that's basically when it topped out. And the bear market really sunk its teeth in the crude oil complex back last summer, and we've seen a crash ever since. So, in fact, the U.S. stocks are the last Ponzi game standing. Bonds have made noises, but they're still, in terms of price, well below their peak levels that they reached in 2012. And yields are still a little bit higher than they were in 2012 at the low when the 10-year yield fell below 1.5%. So I'm looking at some things there that suggest that maybe yields are bottoming here as well, although the consensus seems to be very mixed on that. The U.S. stock market in particular, the last Ponzi game standing, now appears to be running on borrowed time. Today's action is a case in point. We had a strong rally this morning. The rationale for that was supposedly that the ECB is going to print and the ECB is not going to print. The market sold off. Well, this pattern where you have very sharp rallies on the opening and then gradually the price gains get eaten away and turned into a sharp drop in the afternoon, that's a bear market pattern. Now, we don't have clear bear market signals yet, but we've had some hints that things are moving in that direction, and some long-term indicators are still right on the borderline. So that will do it for today. We will get together again next Tuesday. That'll be Tuesday, January 20th. Until then, trade sane, have a great week, and I'll see you next week.